Okay, well, welcome back to another session of Quantitative Brainstorm. Today's session is on systematic macro. This was as always, top voted um, tweet poll. And we'll start with the disclaimer. This is not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. This conversation will be recorded for future reference. As always, it's an open session, so I'll just kind of invite regular people up and we'll see how it goes. I have a bit of prepared some ideas to kind of discuss, and I want to kind of break down what is systematic macro and how it could be important and how it not only could be a strategy within itself, but also kind of augment existing strategies like those found in trend following or value plays. I think that the idea of taking in macro data, or we'll call it non-price based data, can be really helpful, and really just because it gives you more perspective. So a couple of the reasons that I have here why systematic macro is kind of beneficial is this is going to target the largest of large trends. I mean, if you think that you have some, even 1,000-day look back on a price based chart or indicator, that's really not going to be telling you the very long-term stories that we will see in something like inflation or GDP or something like that. You're really able to capture these large trends that are moving the world, which is sounds a bit grandiose, but the idea is that we're looking at how countries are maneuvering, and this causes pressure. And yes, eventually this pressure will be displayed in the price itself, of course. But if you can, one, disentangle why that this pressure is happening, that helps you as the trader potentially understand more. But also, it might give you alternative signals in order to get in and out, or adjust, or use it as an overlay or its own strategy on its own. Um, this extra perspective, if you think about it in like a factors terms, or features in ML, it's just another source of information. It's not coming from the trades of the market itself. There are a lot of issues with taking this data, and this is for a lot of this non-price based data. For one thing, I will use GDP numbers as an example. They get revised all the time. They're laggy, and if you try to find out, when exactly it was out versus you go back in history and look at what the historical GDP numbers were, if you were trading in the moment um, on that release, and then there's a revision, you look back at, say, the St. Louis Fed's website or Fred or something, and it will have gone back in time and it will have re-updated that. So it's very important to be able to record the data as it came out. That's just one example of kind of the complexity behind this. But there's multiple ways to look at economic data. I would say a lot of banks, fund houses in the traditional space still work on analysts' readings. So you can get those off your Bloomberg or Reuters or whatever, or some aggregate website. And this will have a faster update time than what you'll get, say, like the official recording. And you can actually see kind of how the market's positioning for something and like what they expect and what actually comes out. That dispersion between reality and expectation happens all the time in stocks on earnings. You could think about that happening across multiple market shock for a macro number that comes out and misses. So I know that works in equities, and that's just kind of putting to scale what we see in macro numbers versus what we see in, say, like an individual company. Another thing is, the sample size. I want to touch on that because if you have your numbers coming out monthly or quarterly, the amount of sessions you have, like in between that, is quite a lot. And I mean trading sessions or days or whatever. It's going to really reduce the amount of independent observations you have of a certain number. Like I was using GDP. Say you go back to 1950s or 1930s, however far back you can go. Well, I only have 4 good measurements a year, or and then it's been revised, so it becomes a lot harder. It does not necessarily affect your trade um, number of trades, but it will affect the number of times you've seen this thing change, which is a big distinction. So being able to say like, okay, I'm still taking the same number of trades, but like the amount of samples I've seen affect my systems, whether you're using a filter or you have your own independent idea coming into that, that will be reduced. You can start to sample from multiple countries, just like you would, do in trend following, where okay, I have this one thing, really long-term system on one country. Okay, I have GDP of one country. If I start to get baskets of them, then you can kind of increase that sample size. So there's a lot of crossover, I guess. Well, at least I think, maybe because I do have that the trend following bug in me. Um, with what the macro side can do and what we're trying to do, you are definitely trying to. I mean, you could do it both ways. You can try to catch the largest trends and see where the large macro flows are going, where central banks are moving. An example of that is R star. I don't know how many people are familiar with that, but it's like basically the real neutral rate of interest that equilibrates an economy. That is published, and that's something that not a lot of people look at, but it's basically where the equilibrium point of an economy is, and you can look at something like that, and that will give you additional information than just say like, okay, I know I want to probably, I can't say any positions, but take a short in some futures of your U.S. Treasuries or something, or maybe the gilt or something like that. When you can combine those things, you get some pretty interesting stuff. I will leave it there and see if anyone else has anything to add, or you can ask me questions.
Hey, hi Derek. Hi everyone. This subject is fascinating for me. I started my investing research trajectory,
Uh-oh.
travel. I don't know with this topic. And full disclosure,
Oh no.
I try to make sense of a lot of things. I'm an economist, a trained economist, and I think this is the natural
Can I have backup headphones?
way from one thing to the other. And I try to make sense of a lot of things, and a lot of those topics you've already mentioned.
I don't know why this is not
working. They've been gridlocks for me, and the reason why I landed on trend following is because it circumvents all these difficulties. But well, we're not here to talk about trend following. We're here to talk about systematic macro.
Huh?
The first
I
thing
mean, I can
about
hear through this, but
data
I don't know why
release
that's not working.
is
And I missed part of what it was saying.
it's really difficult to circumvent. In the U.S., you do have this database from the St. Louis Fed that that storage different
Sorry.
what's the name of it? Different releases of data. You can have the GDP numbers as they were released at each quarter, but you also have the inflation numbers and what have you. But if you depart from the U.S., it starts to get really difficult. You try to get releases, different releases of European GDP or UK GDP or Brazil GDP, and it's not that easy to get that data. Perhaps if you have a long track of storing your own data, you can start to think about it. But if you're not an economist for the last, I don't know, 40 years and don't have that data, it starts to get really difficult. And the other thing is how to implement these things. I don't know. I don't think we can do on a trade by trade basis as we think on trend following. Everything for me kicked off with a paper from the guys from BlackRock, I think. It's in that it's in a handbook of economic forecasting. It attempts to forecast the exchange rates, and the point of the paper is that a portfolio manager has easier life to forecast as compared to an economist, because the portfolio manager don't have to forecast precisely what the exchange rate in the future will be. If he just forecasts which one will be more valued and which will be less valued, it's enough. Your challenge is to forecast the signal and not the precise number. And then he goes down to his implementation strategy that's really similar to those factor from a French valuation style, where you put a lot of factors and sort them and buy those that are strong and sell who are losing. And apart from that difficulty of different data releases and updates on the past, and I could get some hint of positive return of alpha on this strategy, but it's not implemented. It's mostly an exercise, mostly a backtest. It suffers from this issue of a small sample, and this is Jerry's nightmare. I see he's on the on the line here, and another third topic you just touched on R star. A lot of these economic releases are estimates, and all of them are actually, not all of them, but the huge majority of them. And the R star is an estimate based on different estimates. It's a new level of uncertainty. Every quarter you can run your own models, and they will re-estimate the past from the beginning. I don't know. I don't like to base my investment decisions on so many layers of uncertainty. But we can talk about R star if you want to.
Thanks for that, Bruno. I actually missed the first part because my headphones weren't working. So I did catch up about the data issue, and I do think that that's extremely important because the, say, flagship standard is definitely the US, but as you try to go out more globally, you go to G7s, it's slightly worse workable than you, say, go to G12, and it gets worse and worse. And especially if you've had, say, emerging markets which have a change of regime, as in like the political regime, or they've massively changed their policies in such a way that I don't know, like try looking at what Turkey is putting out recently, or not anyone is investing in Syria, but you get the idea. And even if you go to the 80s in Asia, if you think about how the IMF had intervened quite a bit, there was a large change in the overall general policies of central banking. So the idea that it is difficult, yes, of course, I do think things that are difficult usually have more alpha, just because of that extra hurdle. I don't think that particularly. Okay, I'm not an economist. I know you are, so I'll trust you on the R star. But the idea that we can extract more information from these things to either a create a signal or b augment our signals, I think that still stands, or at least in my experience, it still stands. I'm not sure in other people's, but overall, how you transform that, I think, has to do with how you consider your portfolio. Is it a portfolio of trades or a portfolio system? And the example you gave is quite good. The idea that you can look at it in a factor method and see you can go long and short these factors. I do think that's what the world is doing, to be fair. Um, when these economic comes out, everyone's looking at it and is going to push the markets towards or away from this, number, whether it was meeting expectation or not. There is a information delay that occurs between, say the release of something. I mean, it's super fast now, but like the idea that you have some expectation. The adage is what, uh, buy the rumor, sell the fact. That is an informational lag time. So by nature, I do think that there is something there. I don't know what other people's experiences are with it or how scalable it will be in, say, your area of South America.
Yeah, the the hard part is to make it systematic. I am bombarded by news and expectations and surveys of investors, and try to figure out what's going on and what will be going on in the next hours, days, weeks, months. The hard part for me is to make it systematic, because the 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 ground is moving all the time.
Okay, let me take a step back for a second and let's think about what actually helps a system. Um, if you were able to do in very broad strokes some kind of regime detection, or you were able to determine, say, like in FX, there's a lot of rates that are based on the U.S. rate. We know that is changing. That could imply something, and we can look back at previous relationships. It doesn't have to be discretionary. I am not a discretionary trader or investor. I don't think that the hurdle is there. The key is to be able to pull apart what information has value from that idea, and I think that's where actually having economic training might be difficult, because what's the second and third order effect of something, and then just saying like, no, okay, actually empirically this does give me a 2% extra, something, or it moves the distribution slightly to the left, or it increases the volatility, or things are becoming more uncertain, so potentially there is more risk there because of the generalized uncertainty around certain characteristics. So in broad strokes, you could use it that way, or you could actually try to predict what those numbers would be, such that, I mean, rates traders basically do that all the time, right? That I always thought that rates traders were the smartest traders around. And what they do is they basically mentally are able to aggregate what they believe these central bankers are going to do and what the market needs in terms of safe, safe assets, as in the demand for bonds, and to be able to extrapolate that into a long-term yield curve. And there's definitely work on the information contained in yield curves. There's plenty of academic papers there, and the effect of say rate hikes and things like that, and how they distort certain parts of the curve. So we know that there is a cause and effect. Are you able to disentangle that enough to get something out of it to take a decision is a different question.
Yeah, totally agree. Uh, um, yeah, the issue for me is the sample size thing, because even if you pass all these hurdles, you have a couple of significant events, to give you a hint of confidence that what you're getting is what you expect. I mean, you can have economic theory behind you and telling you that higher inflation will prompt central banks to raise rates, which in turn will drive the stocks down. But when you start looking at data and you start looking at how to make that systematic, what's the level that's relevant to make you to prompt you to any decision, and then things start getting really, really difficult. And just to mention the topic you touched on, regime change. It's I find it interesting. I couldn't get my hands at it yet, but maybe there's an avenue here.
Well, I'm going to stop calling myself systematic macro. That doesn't sound appropriate any longer. I think CTAs are calling me a CTA is fine too, but maybe I need to just go back to being a turtle trader. That's probably more accurate, honestly. So I remember back many years I was working with this firm in Florida here called Ned Davis Research. I don't know if you have heard of them, but they had quite a bit of macro data and were building models, basically. They would build their own model for currencies, commodities, the economy, the stock market, or build a model specifically for the client. And I engaged them to help me do some, strictly trend following analysis with none of their fundamental information. And then they told me that they, how they built models for others. And I don't think they worried too much about this sample size issue when you're combining all of this different data. But the interesting part is they said, that they would tell the clients who wanted these models that, look, please let us include some trend in there. Because if you let us include the trend, that's kind of the final step. If all of these things are happening, the model should be signaling something. If you just pay attention to the trend as well as the final confirmation, it makes these models so much better. And that was what they would advocate to people. But they told me that some of the clients were adamant, no trend. I don't want to hear anything about trend. And to their chagrin, obviously it didn't quite work as well.
Hi to everyone. It's an interesting topic today, and every time we have interesting topics, by the way. And I want to say that maybe 5 or 6 years ago, I thought that it might be a higher level of trader, of professionalism of a trader to be to understand the systematic macro processes. But I did a lot of research in this direction, and maybe not enough research, but I had a conclusion that I don't see the reason for me personally to understand this very complex science. And of course, all skills are learnable, all things that we do almost learnable, but I think that I don't see the reason for me personally to do this, because as I have said many times, and I will say in the future, I'm sure that I have never seen something better than classical trend following models. And of course, it sounds very good when we can have a prognosis, so a prediction, and we trade in the direction with our trend following rules, with a direction or prediction. But I don't see the sense in this, and it's like a filter that can put us out from we can miss a big trend in such a way.
Jerry, you said something very interesting because if you change your name, I'm gonna have to change my name. I the and the idea that you said from the Ned Davis, I mean, they're pretty well known that trend helps, and I also believe this. That's why I think that this the systematic macro is a great partner to trend following. It's because of the feedback loops we always talk about, right? We're always talking about these feedback loops that create trends. So you could think of trend as the symptom of the macro, but actually there's going to be a point where the trend itself influences the macro. And then they go on and on. And the best example of that is commodities and inflation. We've had massive trends in the commodities, especially in the ags, energy, things like that. That goes into the CPI basket. CPI basket goes up. Fed gets scared, prices of that goes up, equities go down. There's a feedback loop that's happening there. You don't need to have more than a simple understanding of kind of the mechanism behind the economics. And I think that maybe I do find some people who are very well trained in economics maybe don't want to take such broad brushstrokes, but I think that that's why they synchronize so well. If you just trend follow, you will catch a macro trend, just like last year in the example I just gave. That is a fact. If you were able to harness that at the same time, would that have given you more or less information? Maybe. Would you have missed a trend like Oleg said? The answer would be no. Because the underlying macro and the underlying price movements are pushing in the same direction. The chicken and egg doesn't really matter because you keep making chickens and you keep making eggs. So as long as that thing persists and continues to have that positive feedback loop, you can still catch it with the pure trend side. So that's my defense for trend following being systematic global macro. Whether you want to add bells and whistles on it is another thing, but it's inherent part of the feedback loop of the economics and how humans process that and apply that information that they have gained into the markets, which then feeds back into the information they receive in like a quarterly report. That like interacting with the market changes the data and changes it in such a way that will continue to push that feedback loop forward.
For me, and from my take on you pros that do this every day with other people's money, is that within a trend following context, I think the macro provides a respectable narrative. And I think a case in point is Jerry's recent appearance. I know he's a regular on the Toss Network, and how the guy kind of rolls out what's happening. Jerry's like, yeah, I mean, that's what price is doing. Maybe it'll do this, maybe it'll do that. But I think it helps frame a context where otherwise, us knuckle draggers or turtles or whatever that are just, one entry, one exit, and one trailing stop or one stop loss. We're just following the price, but it does help contextualize when somebody curious asks.
I'm not talking about somebody here, of course, but on the mass media, I have seen a lot of such guys and see them during the years that have a lot of narrative, a lot of macro narrative, and in fact it's a total nonsense because maybe this narrative it's not a nonsense, I don't know, but guys speak about different things that I, to be honest, don't understand, but in fact he has no good results, no track record, and so I don't understand why it can be good for me at least.
A lot of narratives show up every time, Oleg, and the majority of them are wrong. On that point, you're 100% correct. The thing is, after the fact, we usually find a reason why prices moved one way or the other. And I think the goal of systematic macro, as Derek is putting it, as I am putting it, is to try to find which narrative will be ultimately the right one, and try to exploit that reason that's behind price move. I mean, today we're seeing interest rates higher than they were a couple of months ago, and that's somewhat related to what central banks are doing. And perhaps if months ago we could think about this and try to somehow predict that this would be the quote unquote winning narrative, and then we would be in a good trajectory, in a good way to exploit markets. Then I come again to my point before. The real challenge is to make this systematic. I find this extremely difficult.
I like your point with this that it's extremely different to make it systematic and how to do a backtest here. I don't understand, to be honest. Maybe because maybe I'm aware, I'm not an economist, I'm aware and I like to follow the rules, first of all. Aware by my background, I mean, I'm a trader now, of course.
I think it's maybe to just give some framework about what does a discretionary macro guy do, and then how is systematic doing it, because I hear the word narrative coming up a lot, and to touch back on the previous point, and it does remind me of the Mark Repazinski, I hope I pronounce his name right, coming up with narratives for your fun. Yes, you when the trend is working, you will probably be able to back out a macro narrative. That's true. That is helpful for clients. That is helpful for you to understand what's going on in your system, in the world, and you can connect that in your own head. But I don't think you need to be able to pick what's the right narrative. You just need to see that the distribution of potential outcomes is different. Yes, I'm using my probabilities and maths hat now, but I want to use Soros or as an example, right? And breaking the Bank of England. You could apply the same thing, on the Swiss franc or any of these kind of like major macro peg breaks. And the idea is that they were able to look at the flows going into this thing, and it's supported by one person. And that is, using Hari Krishnan's idea from market tremors. They're the dominant agent in the market. And when that dominant agent ceases to do what they were doing or changes tactic, then you get these really large outsized moves. So it's not necessarily that he could, in that situation, or anyone betting against these breaks, these bank breaks, you can risk a little to make a lot. And that is like a kind of optionality or a convexity or whatever word you want to use it. When these things happen, it's not necessarily that you need to pick the right one all the time. It's, we're going to go back to trend following. If you can find the ones that when they break big, or give you, a good risk reward ratio because of how loaded up this thing is, that's different. And, going back to like, say, normal times, if you're able to use these factors to, adjust the, distribution of potential outcomes, or at least for you to update that, and you think that there's a potentially higher chance for some large dominant agent to change their mind on something, then potentially there is a larger chance for more trend. This is an example that I haven't actually researched that, but that's kind of where I'm coming from. You don't need to know which narrative is right, and the trend will eventually evolve in the way that the narrative is right, because the price and the news and the narrative will all go together in a positive feedback loop. So you can not play in the middle like we do with breakouts. We can wait for major things to happen before that. And so to me, that's how I look at it. I don't actually take straight up trading signals off of this. I do use macro factors and look at a bunch of other stuff. So that's just my perspective.
Derek, and Marcus or Bruno, I guess when I think narrative, and it may be just ignorance on my part, I think, oh, that's the story after you're doing what you're doing. In other words, after the trade's made, where your hypothesis or whatever is what initiates the trade. Where, as a breakout trader, I'm saying, well, if it hits, the breakout, I'm buying it, or if it hits the breakdown, I'm selling it, because I know historically there's a propensity for price to continue. So that's my hypothesis, and then the narrative would be like, oh, okay, well, I went short because of quantitative easing, or what, that's probably why price was doing what it was doing, but I don't care because I'm following price. So in other words, what's your definition of narrative?
I think I can answer that, Brian, and connect to a thing Derek brought up that got me thinking. In economics school, we are taught all the time to think in ceteris paribus terms. That means all else equal, what happened to a variable A when a variable B moves. All the time, we're always doing this static comparisons, and I think this leads to macro portfolio management, because we're always trying to pin out what's the reason behind some price move, what's the reason behind pound going one way or the other. Oh, okay, it's the central bank that must put a lot of money in the system. I don't know. And because we're trying to find these all else equal, what happens to variable A when variable B moves, the job is difficult because it's not just variable B moving, everything's moving. And when I say narrative, I think in these terms, it's everything considered. What was the leading variable to some market movement, to some price action? Oh, the other day the payroll was a down surprise, and that's what has driven interest rates down. Okay, that's the narrative, because everything was moving, but the payroll variable was dominant and in interest rates price action. And then I connect to Derek's point, where you can somehow think of all these variables moving, and the difficult job is to the way I posed it was, it's extremely difficult to know what variable will quote unquote win and become the leading variable to drive some price to go down or up. And indeed, that's extremely difficult. But then Derek comes with a more intelligent alternative.
Oh, I'm intelligent.
That's try to think in terms of probabilities and try to get exposure to. Now I'm completing with my head, and Derek, please tell me if I'm going in the right direction. And try to get exposure to all these different variables and think in probabilistic terms, and when one of them indeed do cause a price move, then you're there to exploit that move. But then there's my question: the implementation of such a strategy involves a lot of convexity, right? you just can't do that in terms of futures or in terms of delta one. I don't know. You do need options to implement such a thing, doesn't you?
Okay, I'll go to the first part. Bruno, you're absolutely right. I definitely think about it in probabilistic terms. The macro factors adjust the potential outcomes that we will see in the market price, right? It's adjusting those things because there's a certain amount of flows, pressures, policies, whatever, that are like shaping the outer boundary of this thing. It's not telling you exactly what's going to happen, but it's going to push things more in one way or the other. And you're just trying to understand, is there a potentially tail like outlying event that is in here? To be able to capture it, no. And that goes back to why I just explained the previous statement. The macro variable gives you the convexity. Because if you are having those shock surprises and it is becoming in price and you do catch that trend, you're in. So that that's where they can kind of go hand in hand if you're already in, and then you get one of these factors. I mean, we could talk orange juice and the freeze in Florida. That's a macro factor for the agriculture market. It's not like anyone decided that was going to happen, but you're already in. Okay, maybe, or you're going to get in, and then now the weather has all of a sudden really given you a big boost in convexity of the position because it's moving a lot faster in one direction than it was before. So you can add fuel to the fire with just doing the delta one itself, because the external effect is pushing the market at a faster rate of change than it would have. Like you said, ceteris paribus, all things being equal. If that didn't happen, it would be moving a lot slower.
So when you look at your data points or your regimes for weighting or for expected run of price, are you using something like kind of the Bridgewater quad type model where you're looking at whatever the macroeconomic environment is that's causing the specific asset class to reflect the price, understanding the whole growth and inflation and policy, Fed policy and fiscal policy affecting like accelerating growth and inflation slowing, you're going to do X. And if growth's accelerating and inflation's accelerating, you're going to do Y. I mean, is that what you're using for your inputs?
I'm going to have to answer this delicately. Um, we do detect certain, I will use the word regimes, that are correlated to those types of activities, whether you could think of some that are like towards liquidity expansion and contraction. You could think of those that will increase or decrease, say volatility, things like that. We are looking at, I think the number is right now like 93 different factors or something like that. And then I'm able to aggregate those together and come up with, I use it in an overlay. I use systematic macro as an overlay to the trend following. The trend following produces the trades itself. The overlay provides this like minor edge, we'll say. I do find it helpful. It has protected us in the past. I mean, it has done its job, so to say. Um, but it's hard for me to say exactly what it is, because it is. I would say it's a quantamental. I hate that word, but it's like I'm following the data, but I'm asking the questions using what we would consider traditional economics theory, and then I'm asking the questions of the data to see, do these data streams that we have coming in actually produce positive or negative effects in this area. So like I think the example you were saying, like inflation or deflation or growth or I don't know, stagflation or whatever. I mean, you can break these quads, or you can do it as many different regimes as you want. But the idea is that yes, there will be some kind of tilting, and that tilting, like I said, doesn't change your, at least how I do it, doesn't change the amount of trades that you're taking. You still have the exact same sample size, right? Um, what it's doing is it can adjust your position sizes. You can take more or less units. You can decide to focus on more or less sectors or something. I mean, if you're doing equities, I've seen people use it. Not my model, but I've seen people use this type of idea, like you said, in rotational strategies where they're like, okay, I want to do cyclicals, and I go to defensive, then I go to growth, then I go to like something. I'm not an equities guy. I'm just making stuff up. But the idea is that you can tilt yourself to where those probabilities, based on the flows generated by these macro variables, will push things. And if they do play out, then you're able to get this, like I'll call it like external convexity, where these numbers maybe, say last year we were looking at inflation shocks to the upside that played out. So that was something that looked like it could occur. Then you could say, okay, well, I want to be more positioned to that because we're getting these like signals. Then you can do something about it and execute that, within your strategy parameters. I mean, that's just one broad-based example, but does that help clear it up?
Yeah, I think so, and I think that's kind of the rub that you folks that use it as a weighting mechanism. How do you systematize it? I guess that's which I love hearing how you incorporate that into the trend model and keep it systematized.
It just outputs a score, and then I use the score, and that's it. I mean, it's like super stupid. I mean, like if I showed it to you after it's distilled, it would be like, oh, that seems like pretty easy. Um, but yeah, I mean, once you have this number, it just goes into how you're calculating things, and you can use it to adjust in any way you want. And in fact, um, one of the things that I did look at was, just replicating this thing specifically for multiple different countries. I did about 12 of them, to see, because like the low sample size, right? So like that was one way to expand that, and just trying to keep the assets in that country and see if like I do get that similar kind of rotation things, and that the score was going to be like, have some information value. I mean, you could say like, okay, T+1, does it do something, or not? And so that was the kind of general approach. I have no human interaction with this thing at all.
That's interesting. If I understand correctly, you're taking trend following signals, and the model is the trend following model is independent, and you increase or decrease your positions of overall trades or specific sectors based on some kind of macro regime. I think that's it. Please tell me if I get it correct. And the second thing is, a lot of this has to do with this regime detection. Do you somehow try to forecast what the next regime will be, or do you, in a way, trust that the current regime is not, it has a low probability of change? Therefore, if you identify what regime you're in now, that's enough for you to take your positions. It didn't sound, but it was a question.
Okay. I think I have a major alpha leak right now. Um, I have seen that there is persistence, in this, and at least in my research, because macro things move slowly, and we are trading in, like what would be considered a fast time frame. Like if you imagine you have 20 trading days inside of a month, and if you're looking for the monthly number, then you've got 20 opportunities to trade. You know, if you're trading a daily signal, if you're trading faster than that, it's even more. So in your period for you to enter and exit, you have like a lot less decay in the time frame of the information. What do I mean by that? Time doesn't move like time in the markets. It moves by, however many trades people are doing, volume, whatever. I mean, informational bars. If you guys are familiar with that part of Lopez de Prado. So if you think about the informational bars or time frame for, say, GDP or any of these things. It's going to be monthly or quarterly, analyst revisions and something like that. Actually, we're quite high frequency at the daily time frame for that. So your decay in your own space of trades will be slower, like, if that makes sense, right? Even though you might have a one period decays like from month to month, but that's still like 40 trading days in between now and then. Does that make sense?
Yeah, makes a lot of sense actually. It reminds me of, I think it's Marco Lopez de Prado point of not looking at the time dimension. It's elusive sometimes. And sorry for the exposure, Derek. And thank you very much. At the same time.
No, I find this area really interesting. Not only from the fact that researching this type of thing scratches my research itch, um, and I do think it helps you understand the system more. And going back to what Brian was saying, like, can you figure out the narrative after the fact? Yeah, absolutely. And does that actually help you learn? Yes. It's not useless to be able to back out the potential reasons for something, because the next time you see that, you might, as the person, be able to identify that. And if you, the person, have seen this thing before, you probably can start to pull apart data to see if there was any kind of precursor condition to that, and then it can become systematized, because you as the person needs experience in the market. It takes, they always say 10,000 hours or whatever, but like, the more time you have with it, the more market regimes, the more COVID crashes and great financial crisis and all this, you do see where, what was different, what was the same, how things moved, and what the world changed like. And everyone is always trying to make analogies to the past, and sometimes that can be dangerous, but it does get you asking questions, and those questions can lead you to maybe an important finding that can be systematized, or a better way to communicate narrative to your clients, or potentially, you know, um, something that you can share with other people. I mean, if you're working in teams, you see something like, and then I'm like, oh, I saw this, but actually, this is going to affect equities teams more. Maybe they also want to share this, you know, regime filter thing, and that would help them, because it does have some value, and it has a track record. So, um, I that curiosity of to be able to push this and to find that, and I do think it follows the golden rules, because, like I said, these are external convex things, and if you do believe in these outliers, it does, it's like, it does have the ability to, like, light the powder keg, which is something that just really drives me a lot, because it's like, if the holy grail is to be able to find the match that blows up the powder keg, if you are able to see that, like, someone does have a book of matches sitting next to this thing, or actually it's raining and nothing is going to happen, that is helpful. And I think that that's kind of how we have to look at it. It's not necessarily a standalone. And what Jerry said earlier, I do think it works well together with trend following, or these other things that are able to catch these outliers. But the idea that the probability of a powder keg going off if there's matches next to it versus a powder keg standing by itself in a rainy field, um, is kind of how I'm looking at it. And then if you can share that with others, or see, okay, well, actually, um, if this happens next time, there's probably going to be a set of matches there, then that's something you can try to disentangle, because probably we're all going to be doing this for decades to come.
It sounds like one of the goals can be to not trade 150 markets or 200 markets, really small little bets, lots of diversification, but rather hone in on a place where you can be really piggy it kind of reminds me of Druckenmiller and Soros, although Soros, I think, is a bit more, he admits a bit more to trend or whatever he calls reflexivity or whatever he calls that. But Druckenmiller, I've been to one of his annual meetings, and he put up a lot of Ned Davis charts and stuff. But I think he also, maybe pays a bit to trend, although he's sort of bad-mouthed stop losses, I think. But in order to get the big killer profit, like the Bank of England or mortgage backs, you probably need to combine a bit of this fundamental systematic global analysis with maybe the trend as the trigger. Now you can short the mortgage backs. And so I have a small position in an ETF that, because it's kind of in a downtrend, but it's one of, 150 positions. But I remember Paul Jones saying, he just can't believe he didn't crush that trade. He never heard about it. He wasn't looking for it. How do you do it? And so I think that as he sort of admitted over the past bunch of years that he likes the 200-day moving average, he may have been too focused on that trend stuff and liquid markets, exchange traded markets to find something and figure out a way to go all in on it. But I think it's just a mentality too. Like, I have no interest in going all in, but I do think that is the preoccupation of most people.
And so I have I have a little question. I'm sorry, something with my network. Isn't this the same if we say looking at the chart, maybe 1 month chart, very big chart, and do analysis, and we see, for example, on euro United States dollar, we see uptrend here, and isn't this the same if we do this macro global analysis and we predict that it will be in the future, it will be the price will increase?
Jerry, and I will also get to Oleg, but you're absolutely right about the pigginess or the chickenness, potentially, if we're going to keep talking about farm animals. Um, that is, kind of the framework that I'm using, and that you can decide to do those things, but you still take the trade, and you don't have to focus or reduce your amount of markets. You can adjust it to however many you want, but like, you can imagine that you added 1 or 2 extra units if it looks better than normal, and so you risk, instead of 25 bips, you risk 50 bips, or 40 bips, or whatever your unit size is. And I mean, if those things do come together, you'll have a monster trend, and you will be able to get more out of that because your position was larger, but it doesn't have to go outside of your risk limit. And then Oleg, I think you got it. You really nailed what I was saying earlier about this, like, macro and price trend feedback loop. If the macro goes first, you'll have a trend anyway. If the trend goes first, you'll probably get a macro news. They will feed into each other into a circle, and that's why I think that they go hand in hand very well. Is because you will eventually get this one pushing the other concept, and if you can get that reflexivity, if that's the word we're going to use, or this positive feedback loop, then both will start to do this kind of breakout action, both the economic figure and the price itself, because they will need to be reflected that way, right? The humans are going to have to react to the price, and then they're also going to react to the news, and then, like, the news is maybe the price is moving up, so then it's going to change the news to get more drastic, and then and that is really kind of how I see systematic macro, or at least what I do with the perspective of the trend follower, and doing it in a systematized, non-discretionary way.
I said that because for me personally, I think it's less complex to create. If I used filters, I don't use filters. now. But if I decide to do this, it's better for me to trade all the trades in the direction of maybe 200 days breakout, all the trades in a shorter time frame, for example. But take only the trades, use a filter 200 moving average or maybe 200-day breakout, and it's much more easier to me to do this type of analysis. So I see the direction of the trend, and I do my decisions in a more short-term space. I don't do it now. I have said it before, but I'm talking about it in theoretical way. And so it's more for me, it's more easier than to do the global macro. In fact, I don't understand all the factors of global macro. I don't understand in fact how it can be done in effective way. And I know some theories about this, but I don't believe in it much.
Boris, I saw you raise your hand. Maybe you want to say something?
Yeah, sorry, I think I caught the tail end of that, to be honest, but are we talking about combining macro or fundamentals with like technicals, a trading system? Is that what we're talking about, or did I completely get it wrong?
No, you're right.
All right, fair enough. The one thing I would add is there was some work done recently by, I believe his name is DWongResearch. I could be butchering his last name, but he worked for Wellington. I think he's retired now, but he has a YouTube video there for the CFA Society. I think two, one for the Boston chapter and the other one for the chapter in India. But he's done some work of how he combines the fundamentals of the macro with the technical, and he's a pretty known trend follower, so it might be worth checking out for folks to see how he does it. There's some interesting concepts there.
I just want to go on record and say that I have a responsibility, on this chat to maintain my consistency for at least for OLAG, right? And it would just be a disaster if all of a sudden I started agreeing with trend following plus something else. But I would say that it is not possible from the way I look at classic trend following to improve the trend following. You cannot improve it by adding other things. I think you can philosophically agree with that, and I think you can prove that. However, it's definitely possible to take this systematic global macro and maybe add a bit of trend to it and make it better than the trend following. But there is no way to, in my opinion, improve the trend following system with other factors. And I just remember while I've been listening to this, another thing popped into my head is that I've tweeted and read articles over the years about the misconception that more information is better. And people would write these articles and give reasons why that isn't the case. But it's probably mostly revolves around a classic trend following point of view, that there's no way to improve the classic trend following. And I think another kind of secret, idea embedded in that is that the sample size problem. You haven't improved it when you've increased the sample size, which is really what the trend following gives you, this simplistic rules-based way that you're just generating thousands of trades and then add something into it. Well, then you've screwed it all up.
Yeah,
Totally,
exactly.
I totally agree with this because I have not found, maybe 5 or 6 years ago, I wanted to find a way to improve trend following with something, but there is no way. I'm sure that there is no way to improve. There is only ways to do it more complex, more less performance and something like this, and this combining with something else, they do such job. And I think that trend following is based on the structure of the market, structure of the price, and of the laws of, as I was always say, on the laws of nature. And so we can't maybe do something here, at least at my point, and I totally agree with Jerry, we can't improve it in such way.
Yeah, the only thing I'd say to that is I think his point of the presentation, which I agree with, wasn't to improve trend following, but quite the opposite, was to improve the macro approach. I mean, he's a former hedge fund guy, or at least worked for the hedge fund. So it's improving the macro by using the trend following, right, as a methodology, as a technical methodology. What you see with a lot of macro guys is that they don't care much for the technicals. They don't care much for having a methodology of when to buy and when to sell, which trend following does a great job. So his presentation, worth watching for sure, is how to improve the macro and how to combine those two methods, not necessarily how to improve trend following. So worth mentioning that distinction.
Jerry's going to answer. You want to improve macro? Throw it to the trash and use only trend following.
Yeah, except good luck convincing any of your hedge fund clients with that one.
That's exactly right. And you can win your little personal battle, but maybe winning the AUM battle is better. And I do think that, it is a mistake in my career not to have realized that and to been 100% dedicated to trend, but been able to speak that language of macro. And I think a lot of firms do that. But I don't think that there are a lot of firms who are hardcore dedicated classic trend followers who, you know, have a great story to tell about macro and hire these people, and then they secretly don't use any of that. I think that it does not only creep in, but they want it in, and they believe in it. They don't believe in trend following only. Um, it kind of reminds me of that Saturday Night Live skit where when they shut the door, Reagan is in the White House and he becomes this incredibly genius person, where the press had portrayed him accurately so as not being a genius, smart person. And so I think that I don't think there are a lot of people when you close the door, they're talking about how they fooled everyone because they're really hardcore trend followers, even though they talk a good macro game.
I wonder if I should just start doing that instead.
But it gets back to your point, Eric, that um, uh, uh, the reason behind trend following working and the reason behind macro working, if it ever works, they reinforce each other.
Sorry, just to clarify, when you guys say the macro does not work, are you talking about an actual trading strategy? So you're analyzing, all the data, crunching all the numbers, and then essentially buying and selling based on that. Are you saying that part doesn't work? Because saying macro doesn't work is kind of strange to me, just because the trends are created because of the macro factors. It's just that I don't believe we can all know what they are. I haven't found a trading system that allows me to exploit that. So I just want to clarify, like, what do you guys mean when you say the macro doesn't work?
No, Boris, I'm just getting back to a point we were discussing previously, and that obviously there are economic reasons behind price move, but there are also reasons that are not tied exclusively to economic causes, and that's where trends show up and surprise everybody. And when I say that these things reinforce each other, it's well a point Derek made just a while ago, that you get one thing pushing the other in the same direction. So I don't know. You have some kind of weather reason to push prices, and then that's a non-macro reason. But then I mean that's a macro reason, and then people start seeing prices going up and start readjusting prices up, and then you have a different reason that's not macro itself. It's reacting to higher prices. People start expect even higher prices, and then you feedback loop.
Yeah, I think I understand what you're saying. I definitely agree. I think you know, one of the amazing things about being a trend follower is I don't have to think about any of these things. I mean, I'll analyze and check out volatility and, you know, have an opinion or two about the economy, but it doesn't affect my trading in any way. And it's an amazing feeling to not care at all.
I want to say that it's really, I liked it very much. It's really amazing feeling to not think about this. It's really, I understand what you are talking about. It's amazing feeling.
Then again, it's not an amazing feeling to be a trend follower, um, especially when you get hit with a slew of losses and you're in drawdown most of the time. But you know, it is what it is. We gotta hang our hat somewhere.
I think it's more amazing to be a trend follower because as a trend follower, I understand how my system works. I know all the information I need. I know my rules, and my rules is the information I need. And I can see a lot of sample size on different markets, and we have universal sample size for all the markets. And so it's amazing to be a trend follower.
Let's just say one thing though, just playing devil's advocate, because I haven't done that in a while here. But when you say I know my system, I know what to expect. Let's say you were a short-term trend follower trader, right? And that worked perfectly fine. You know, let's just say you're taking breakouts, 20-day highs, whatever, 10-day lows for exits, whatever the case may be, just a shorter term trend following system. That clearly stopped working, right? At some point in time, you'd have to adjust. You'd have to know that that wasn't successful anymore in the current market. I know obviously if you've done the back test, you would always see that the higher or the longer speeds there, the longer breakouts would have worked best. But I guess it's this theory of knowing your system and knowing what trend following is at all times.
I want to say that all systems has the periods of underperforming periods. And I was a short-term trader, and it's not the best approach, I think, not the best short-term controller trader. And but we have a lot of, as I have said today, we have a lot of sample size, a lot of samples. And as Jerry teaches us, we can look at weekly chart, we can look at monthly chart, and we see that, I liked the phrase of Moritz Siebert. He said that if you look at 40 or 50 years chart, it's very strange that how not to want it. So I think that it's a lot of confidence in trend following if you learn it, how it works, study, do the back test, I think it's a lot of. I believe in trend follower.
It takes a lot of data to be able to determine whether a system is broken or not, or one system is statistically different. If you're trading a trend following system on the daily time frame, you're probably going to need at least 30 years, if not 50 years of data to determine something is busted. So that becomes a real issue. If you're trying to compare two things like a 100 versus 200, then like they're already pretty close. So, you're going to need more sample size than that. And that is kind of a big negative when it comes to long-term trend following, because it will probably only be able to detect something that was broken today by the time you retire. So, I mean, I think that I just want to bring that up.
But I think that with a very high probability, there is nothing to broke, nothing factors to broke in trend following, like in simple car maybe, only engine.
Well, I think if trend following goes away, right, as a concept, then we have bigger issues than trading, right? Because there's no trends then to exploit, and that's an entirely different issue, just globally. But I think there can be a period where it's very, very tough for the individual retail trader to profit from trend following. So even though the concept may be alive and well, as a system for you to put dollars into your bank account, there might be periods that are tough. Now I'm willing to sit through those periods, right? But I guess I don't know how many people would be if for 5, 6, 7, 8, 9, 10 years of your life you're not getting the returns. Um, I believe in the concept that, or trend following as a concept, that it will still turn around, but it's easier said than done, is what I'm trying to say. When if for 5, 6, 7 years you're not seeing your account equity go up. Um, that being said, though, I did want to bring something up, I guess, to folks here and tomorrow to the chat room as well. Uh, just if we can maybe talk about tools of the trade. Now, I know we can't improve trend following as a core concept, and there's so many different people that use different tools, right? So trailing stops, people use different trailing stops, different breakout periods. I know this has been discussed, and I know nobody wants to give away their secret sauce, but I was just wondering if anybody in their back tests, or if they kind of came across something new or interesting that they could exploit to see if it could either not improve things per se, but just give them a bit of a better edge. I think one of the things I'm looking at is how volatility helps or takes away from breakouts. So even something like measuring the distance between the two highs and lows. So let's say if you're doing a breakout of 100 days, you would measure the distance between, the two, and then calculate as a percentage. And when you see that as an indicator kind of going down, it means the volatility is compressing, and any breakouts in that direction could have a little bit more juice behind it per se, as opposed to volatility has expanded. I know it might be a bit of a foreign concept or whatever. I have seen that used somewhere else. I can't recall where, but just wondering if anybody has kind of come across anything interesting that they'd like to share on the quant end that it's worth pursuing, whether it's about trailing stops or, some filters or anything of that sort. Because I'm kind of running out of ideas to test.
I thought this was me sharing some new idea that I thought would help, but I think it's been squashed.
Oh, you mean the volatility one?
No, this macro thing.
Oh, crap. Okay, no, my bad.
No, but I mean the volatility thing. I guess I can touch on that. It's an interesting concept. I think I tested it. Oh gosh, 10 years ago, maybe something like that. It's been a while. The idea that we get some kind of compression, I think, is the idea. I don't. Well, I never implemented it, so that probably means I didn't think it was that good. But I don't actually remember what it was. Sorry.
Yeah, no, fair enough. And no, I actually just understood right now the systematic macro. Sorry, I got my first day off in a very long time, so I just jumped in because I was excited to talk to you guys. But yeah, no, fair enough. Ignore that question, I guess. We can stick to the topic. That definitely didn't want to derail it. But yeah, maybe worth posing tomorrow.
Boris, you might want to go back and listen to the last systematic investor episode with Rob Carver, because in there was a brief exchange between he and Niels regarding volatility trading, and Niels pointing out that volatilities mean reverting, and Rob indicating that he had more of a true trend process. Just kind of hinted at it, and they said they would follow up in greater detail the next time he's on. So you might give that a listen if you haven't already.
Yeah, okay, awesome. Thanks, Brian. Yeah, I'll check that out.
All right, I will leave it open for a little bit to see if anyone has any other comments. Otherwise, I'll wrap up the room.
Thank you, everyone, for your time.
Thanks, everybody.
All right, great. I guess we'll see you all tomorrow.
Yeah. Thanks, guys. Thanks, everyone. Goodbye.